I'm Brent Joyce, Chief Investment Strategist at BMO Private Wealth. It's Monday, November the 3rd. Welcome to our Global Markets Commentary. Despite a fog due to the lack of most official U.S. economic data, capital markets continue to forge ahead. It is serendipitous that the dearth of official data coincides with the start of corporate earnings season. Take banks, for example. They're a good barometer for the economy. And despite some prominent bank CEOs trading barbs over the potential for cockroaches in their lending books, U.S. banks reported strong results and delivered constructive commentary that consumers remain in solid shape and financial conditions are supportive and unlikely to be affected by a few isolated credit events. When it comes down to it, a lot of the parsing of macroeconomic data is really about trying to predict corporate earnings. For equity investors, earnings are everything. We are encouraged that earnings continue to be the single most positive piece of information underpinning our conviction that equities remain attractive. Two things stand out to us as very constructive in the current reporting season. First, earnings growth is broadening beyond technology. Second, within the AI space, investors are becoming more discerning, asking questions about the bottom line, and rewarding companies with good answers and punishing those whose answers are lacking. First, the broadening out. For the S&P 500, the percentage of companies beating expectations on consensus earnings hovers around 80%, a very healthy number, and well above the 1- and 5-year averages. It isn't just a concentrated tech story. In addition to technology, the real estate, materials, financials, and industrial sectors sport Q3 earnings growth north of 10%. Strong corporate earnings underpin the jump in Japanese equities. Even in Europe, where earnings growth has been weak due to sluggish economies, the proportion of European companies exceeding earnings estimates, albeit modest ones, is the highest since the first quarter of 2023. It's very early in the S&P TSX earnings reporting calendar, but growth around 15% is expected, marking a third consecutive quarter of double-digit growth. As for the more discerning part, investors are becoming more focused on the expected returns from the mountains of cash that hyperscalers are spending on AI investments. Companies like Google, Apple, and Amazon are being rewarded for their AI spending because they have existing platforms that are viewed as conduits for AI deployment. And hence, they have better visibility on how their AI investments can bear fruit. Meta was unable to provide the same level of comfort, and the shares suffered. Deal making is also under scrutiny. Investors are on alert for overexposure to single entities and investments that appear circular between a small set of companies. Microsoft's ties to OpenAI are on investors' radars, for example. This disciplined mindset differs from the overexuberance, just buy it because it had .com in the name mentality that marked the 1999 internet bubble. The impressive returns of the past few months have our antenna raised for some near-term choppiness, especially once the U.S. government eventually reopens and a deluge of readings on the world's largest economy come pouring out. In our view, a breather for equity markets would be healthy and welcome. Longer term, we continue to see conditions conducive to equities outperforming fixed income and opportunities remaining within equity markets. We do recommend harvesting profits regularly and rebalancing your portfolio. For those with future or regular funding requirements, such as purchases, living expenses, RIF withdrawals, or taxes, consider taking advantage of current market conditions to top up the cash allocations needed for these. That's the way we saw the month of October 2025. Thank you for joining us. We look forward to you tuning in next month.